What's going on, Mountain Seniors? Today is May 11th. It's 2020. We're back at it again, doing another video. As you can tell, my hair is getting really long, and I got the creeper mustache going. We're gonna finish the macro unit today, and then from there, I'll post the study or review thing tomorrow. I'll post the test probably on Wednesday. Again, none of this stuff can hurt you. It's only there to help you. And then from there, we're going to kind of get done wrapping up the year. We're going to finish kind of our last unit, and that'll be that. Okay. So let's go ahead. Let me share the screen here. Boom. Okay. We're going to continue building and talking about our where we left off, talking about like stocks and the stock market and whatnot. So hopefully you found the last video kind of beneficial. Today we're going to build on that. So first off, you got to be able to know how to read stock, okay? And so what I mean by that is if you were to go to Google right now and you were to look at Amazon, okay? If it loads, don't be slow on the internet. Amazon stock. There we go. So what is this? What are these numbers? What's the green? What's the plus? What's the percent? What's the NAS? What's the AMZN? What is that? What does that mean? Well, it's a little bit, straightforward, you would think, but I just want to go over it to make sure. So we can look at it either the slide, but I'm going to look at it at Google because that's just how we look at things today. So right now, Amazon is traded on the NASDAQ. The NASDAQ is where a lot of the tech companies are traded. That's the purpose of the NASDAQ. It wouldn't really be Amazon and other companies such as like Apple, Google, etc., Dell, Microsoft. They're going to be on the NASDAQ just because they're technology companies. That was kind of the purpose of the NASDAQ. And obviously, as a lot of these technology companies have become so big, the NASDAQ has become a pretty popular place to buy and sell stocks. It's become a popular stock market. It wasn't always that way 20 plus years ago when these technology companies were in their baby years, but now they're full-blown mega companies. So AMZN, every company that is publicly traded has like an acronym. So like Rite Aid is RAD, RAD. What else would you might know? Rio Tinto is RTP, like ResMed is RMD. Every company has a acronym. It's just the easier way to find it. So that's first. This big number is the price that I'm highlighting. That's how much it costs to buy one share. When the stock market opened this morning, based here, its value has increased by 27.63 points. Well, now obviously it changes. It's constantly changing. 28.03. So the price has gone up about 1.18%. So, and this just goes to show you where it started and how it's kind of proceeded through the day. This is the graph, okay? The open is where it opens. So today, on May 11th, East Coast time, when the stock NASDAQ opened, it was at $2,374.70. The high it's been today was at $2,416.99. That's the high. There's obviously a low, meaning the low it's been at, okay? And then some other things here before I get into the other ones over here. We can look at a graph over 5 days, 1 month, 6 months. YTD means year to date, how it's grown year to date. So actually, if you had bought it back in March when the stock market was kind of dropping, you would have made a decent amount of money off that investment. Again, if you look at the max, you can see its growth and whatnot. Okay, but let's just look at the day. So MKT cap, that's market cap. That's what investors believe the overall market cap could be for Amazon, the amount of business and money they could do, which is 1.2 trillion. Amazon has a huge market cap. It's going to be a lot bigger than any other companies that we're going to see. Ooh. We'll get the PE ratio in a second. Let me go back here. DIV. Let me show you previous close. Previous close shows where it closed the day before. So it closed at $2,379.61. Even though it opened lower, that can happen because people are like, in the very beginning are rumoring and talking about where they're going to sell it. So that can affect the open price. And then this is 52-week high and a 52-week low. So 52 weeks is a year, but it's 52 weeks from this point or a year ago. So 52-week high, 52-week low is measuring from May 11th, 2019 to May 11th, 2020. So when you see that 52-week, make sure you're not getting confused that, oh, that's the 2020, number. No, that's like the 52-week number. So, whole year from like in real time. And then finally, we have the PE ratio. This is the price earnings ratio. This is to show whether or not a company it's one metric of a way to show if a company is being overvalued or undervalued. PE ratio stands for the price earnings ratio. Pretty much it's going to show you per share price how much you're going to earn on average on an investment. So most people on average from the time they buy to sell, it's going to be about $114.95. So, that's a good way to see, oh, this is the historical averages of what you can make on this stock. So it's a pretty good way to, good measure to determine how much, hey, should I buy, how much I should buy, so on and so forth. But that's just the average. Okay. It's different for every company. There's one thing here called DIV yield, and it's not listed. DIV, that's shortened for dividend. A dividend is used sometimes by certain companies when they sell stock as a way to encourage people to buy. What a dividend is let's say I buy a share in a company that sells a dividend. We'll call it like Southwest Airlines, okay? And Southwest Airlines says, hey, if you buy some of our stock, you get to, obviously own the stock, and then you'll also throw in dividends. A dividend means you're going to get a very, very, very small percentage of a company's profits over a given amount of time, whether it's every month, every year, every 2 years, it depends on the deal. So some people find that attractive because they're like, not only can I make money on the company, I can make money a small fraction on the profit. The problem with a dividend is just like in the ways you can make more money if a company does well, you can also lose money because if a company takes on losses, it's going to cost you and whatnot. So that's the deal with dividends. Usually they're cool, but to usually have access to a dividend, you got to pay a lot of money and stuff, or own a lot of shares. It's kind of the way that works. The only other thing that I think that I want to show you is like volume this would be volume in the hundreds, right? Volume of stock means how many shares are available. So like, for example, Richie BR, there's 1,500 stocks available, whereas, Rite Aid has 3.1 million shares available. That's just volume in hundreds, okay? So volume means how many shares are available. Slide 70 on the left, that's James Bond. On the right, that's future. There's usually a joke I do in class with that, but I'm not going to do Bonds and futures. We got to talk about all the different ways you can make money. So bonds. Bonds are kind of in the stock market as well. Bonds are like an IOU. Basically, it's borrowing money with the intent of paying it back later with interest. Usually bonds are really long-term payoffs and investments. Think at least 5 years plus. For example, a lot of times banks sell bonds. Let's say I buy a $10,000 bond from the bank today, and the bank tells me that for that the particular bond, they're going to pay me back 1% a year for the next 10 years. So for the next 10 years, the bank pays me $100, right? I bought a bond, $10,000 bond from them. And then finally, in the 10th year, the bond has matured. I get all my money back, my $10,000 plus my 1% interest that I've been earning over the past 10 years, which was that extra 1,000, right? So in total, I was paid $11,000 for buying a $10,000 bond. So I made $1,000. A lot of times when people are born like kids, you know, your grandma or grandpa will buy you a bond. You're never going to get rich making bonds unless you buy a lot of bonds, which it's hard to. You got to have the capital for it. But bonds are safe, secure, and they are almost always guaranteed to grow. So if you do want to get into investing and you really have no idea and you really are conservative and you just want to make money in the long run, look into buying bonds online, or if you set up a mutual fund, shift all your money into like bond type stuff. And we'll get to that towards the end of this video. Futures. This is an agreement to sell a product at a future date and time at a certain particular price. A lot of times this is used in agriculture. So for example, let's say Mr. Tomei is going to grow a field of tomatoes, and it's going to take 3 months for my tomatoes to fully develop. Right now, on May 11th, tomatoes are selling for $2 a pound, and I'm planning to sell my tomatoes to Safeway. Well, Safeway thinks that the price of tomatoes are going to go up in 3 months, so they want to agree to a future contract with me that locks in the price based off today's price. That way, Safeway in 3 months, let's say if the price went up to $3 per pound, Safeway would have to spend extra money to get my tomatoes. But if they agree to a price right now, right, then, you know, they're going to save money, right? They're going to save like $1 a pound. A futures contract can also hurt Safeway because if the price of the tomatoes goes down hypothetically in 3 months, Safeway then locked in a deal that they overspent. So futures is kind of a gamble. You got to really know how the future price is going to be, and you have to be able to negotiate what you think is a fair price for someone to accept. Because obviously, if the farmer knows the price is going to go up to $3 in a few months, and both parties like are pretty certain in that, the farmer is not going to sell or agree to a futures contract at $2. So it takes like careful planning, negotiation, being able to predict the future. Futures are in certain areas safe, in other areas they can be risky. It depends on what you're selling, what type of commodity that you might be selling. Let's go to options. Slide 73. Options are typically given to employees of a company. Instead of taking a higher salary, the employee defers some of their salary into stock options. The employee then can sell those options one day if the company goes public. What this means is, for those of you who might end up working for a startup company one day when you get your first big girl, big boy job, a lot of times startup companies offer you the chance to have an option. For example, Apple, many, many years ago, had 25 original employees. 24 of them became millionaires. The only one who didn't become a millionaire was the one who didn't take the stock option. This is like the famous like Apple story, you know, and is all, you know, it's like, oh man, everyone was a millionaire except that one guy. But here's the deal, you know, taking stock options and deferring salary, right? Let's say you give up 10, 20, 30, even more thousands of dollars in salary. Sometimes it's more important for you to have the money now than it is in the future. You also maybe work for a company, you don't know that they're going to be Apple big and they're going to become huge. So it's a risk to take a stock option. But it's a way for companies to allow them to save money at the beginning of their growth period, and then hopefully if they make it big one day, they get to reward their employees who made sacrifices at the beginning. So it's just a way for companies in the beginning stages of development when they're growing to save money and grow at the beginning. We're almost there. Portfolio. A portfolio is just a range of investments held by a person or an organization. It's managed by a portfolio manager or yourself. So a portfolio could be like all the things you've invested in, whether it be property, stocks, let's say, like you're invested in like oil or gas or other things. So it's just your portfolio is your wide variety of investments. Which leads us to diversifying. It's important to have a diverse portfolio or a diverse number of investments because some people are dumb and they only invest in one thing. Like I had a lot of friends who were like, I'm just going to put all my money in Bitcoin. You might have heard of Bitcoin and cryptocurrency. We'll talk a little bit about that in our last unit. But a lot of people are like, yeah, this is the future, this is the way. And a lot of these people saw the price of this cryptocurrency rise. They thought it was going to keep rising and they didn't sell. And then it went down. And because that's all they invested in, they lost a lot of money because they didn't diversify and spread out their money. You never want to just put all your money in one market. You want to spread it out. Maybe you put it in stock. Maybe you put some in bonds. Maybe you put in maybe you have a little property investments here and there. You want to diversify just in case if one goes bad, the other ones maybe are okay and will keep you afloat. Right? That's why you want to have a diverse portfolio. That's my advice to you, diversify. Easiest way to get into the stock market is through mutual funds, 401ks when you guys get a job. A mutual fund is a very basic portfolio. It has pretty much most standard companies that you would find or basic companies that are safe, secure. I think Disney, Chevron, Apple, etc. There's different varieties of mutual funds. Think of it as kind of like it's a sandwich you can order at like Ike's or Togo's, and there's like instead of like having a dozen different sandwiches, there's 100,000 different sandwich varieties. That's all a mutual fund is, and you can kind of choose. A mutual fund is what a lot of people use to rely on retirement. A mutual fund can be funded by a 401k. What a 401k is, it's a form that's used when you first get like your first real job. The company will bring in people to talk about setting up a 401k for you. And what that means is at every paycheck, you can contribute however much you feel comfortable into your 401k, whether it be $10 a month, 100, a couple hundred, and that money then is invested into a mutual fund. That's your 401k. That money goes into a mutual fund. And then over the course of your 30, 40 years of working, your fund grows and grows, and hopefully it grows enough to where you can retire. And that's kind of how most Americans here, that's how we retire. You have to invest your money in the stock market to grow to be able to retire. That's how like you're going to be able to hit the $1 million+ mark that you're going to need to survive through retirement. You're probably going to need more. $1 million was the old number. It's probably closer to 2 million now. Or at least it will be in the time that we need to retire, just with the way inflation goes and whatnot. But a 401k will follow you in the private sector wherever you go, even if you change jobs. So, just because you go from one job to another, chances are your accounts will stay the same through the 401k. If you're not going to use that and you just want to go independently, You can go to E-Trade and TD Ameritrade, where you can just manage the portfolio yourself and your own money and your own retirement that way. You can also hire like a stockbroker to do it for you, like a money manager, a money market account manager that's employed through these companies. E-Trade and TD Ameritrade are just some of the bigger ones. These were companies that, you know, took off the whole online trading. You know, there are people who like work in their basement and are millionaires because they knew how to invest in E-Trade and TD Ameritrade. You can do that. It's, you know, it's your call, but it's hard to do that when you have a full-time job and you have kids, and like it's kind of stressful. I mean, it's kind of like gambling every day. You know, it's just a stressful life, especially when you have other things going on. So that's why I just let other people manage it, and they take a very small percentage, and I'm okay with that because I'd rather have less stress in my life than have to constantly be checking stocks all the time. Some people do it, it's just not for me. Biggest advice for you is to just be careful when buying stock or really engaging in any business deal. I hear all the time from high school kids, like, just getting caught up, or even just like people in general, just getting caught in the dumbest things because it's a deal that sounds too good to be true. It's literally the old saying, if the deal is too good to be true, it usually is. That's just, you're never going to get offered a deal where you're going to be the winner. The reason someone offers you a deal in any business transaction is because they're trying to get something out of you. Every time a sale happens for Nike online, it's because they're not trying to, here, we're trying to help you out. No, it's because they want your money. So you got to always remember, you're always going to get screwed in a deal somehow. It's about how much you want to get screwed. How willing are you to get screwed? If I would never go into anything blindly and think this is going to work for me. You always have to think when you get a job, when you start investing, when you, if you ever buy a house, anything, you always got to think, okay, how am I going to get screwed on this? Right. And you got to be able to understand, okay, am I comfortable with losing this much, whatever the potential fall it is? Am I comfortable getting screwed over this way? If you think with that mentality and you're more conservative in that sense with your money, you'll do well. If you're just lolly-dolly, like whatever, it sounds like a good deal, you're gonna get hustled and finessed throughout your life. So just be careful, okay? And that's my advice to you. Besides that, that's pretty much our video for this whole unit. We've wrapped everything up. If you guys have any questions for me, feel free to email me, let me know. Besides that, have a good rest of your day. Take care.